Hello Rogers TV, welcome to Smart Money, the show where we teach you how to make the best use of your money to reach your goals in the most efficient way possible. Consider me your financial GPS. I'm your host and wealth advisor, Mitchell Huynh. The past few weeks we have discussed personal finance. This week we will be speaking about business finance. Whether you are thinking about starting a business or looking to learn about more tax efficiencies and investment opportunities within the business, this episode is for you. When you first start a business, you do so for many reasons. You want to be your own boss, set your own hours, gain financial freedom, or have a great idea that no one's have thought of yet. The list goes on. One of the most important decisions you will make is how to structure your business. There are three main types of business structures: sole proprietorship, a partnership, and a corporation. A sole proprietorship is the easiest and cheapest way of starting a business. As a sole proprietor, you would be fully responsible for all the debts and obligations related to your business, and all profits would be yours alone to keep. All income net of expenses would be taxed at your personal tax bracket. As the sole owner of the business, a creditor can make a claim against your personal or business assets to pay off any debt. This means you have unlimited liability for any debts owing. A partnership is a good business structure if you want to carry on a business with a partner and you don't want to incorporate your business. With a partnership, financial resources are combined and put into the business. You can establish the terms of your business with your partner and protect yourself in case of a disagreement or dissolution by drawing up a specific business agreement. As partners, you would share in the profits of your business according to the terms of your agreement. When establishing a partnership, you should have a partnership agreement drawn up with the assistance of a lawyer to ensure that you're protecting your interests and that you have clearly established the terms of the partnership with regards to issues of profit sharing, dissolving the partnership, and more. Partnerships have certain drawbacks, so similar to sole proprietorship, there is no legal difference between you and your business. Therefore, you have unlimited liability. So if you have business debts, personal assets would be used to pay off the debt. It's hard to find a suitable partner. There may be conflicts between you and your partner. And on top of that, you are held financially responsible for any business decisions made by your partner. Another type of business structure is incorporation. Incorporation can be done at the federal or provincial level. When you incorporate your business, it is considered to be a legal entity that is separate from the shareholders. As a shareholder of a corporation, you will not be personally liable for any debts, obligations, or acts of the corporation. It is always wise to seek legal advice before incorporating. There are certain advantages of a corporation. You have limited liability, meaning debts can only be claimed to the extent of your business assets, not your personal assets, thus protecting yourself. Ownership is transferable through selling the shares of the business. There's continual existence of the business when you die. Therefore, your corporation can continue to exist and operate should you choose to do so, as it is a separate legal entity. It's easier to raise capital, once again, through the selling of shares. There are possible tax advantages, as taxes may be lower for an incorporated business. You may also qualify for a small business tax exemption on selling your business, meaning approximately the first $800,000 of capital gains on the sale of your business will be and may be tax-free. There are certain disadvantages. A corporation is more closely regulated. It's more expensive to incorporate than to form a partnership or sole proprietorship. You need to keep extensive corporate records, including shareholder and director meetings. Documentations need to be filed annually with the government. And once again, there may be possible conflicts between shareholders and directors. Our primary interest is corporations due to their many tax and liability advantages. There are many financial strategies we can use to our advantage. So first, let's take a deeper dive into corporations. Most small businesses in Canada are able to take advantage of the small business tax deduction on the first $500,000 of income. That effectively reduces your business income tax to approximately 15%. If we compare that to your personal income tax bracket, which can range anywhere from 20% to 52%, this is a huge tax savings. Almost 37% income tax savings between the highest personal tax bracket and the small business tax bracket. A key strength of corporations is that you can control your personal tax bracket by limiting the amount of money you take as an annual salary. Let's say that after all expenses, your business generates $116,000 of income a year. So that's after all expenses and salaries have been paid to yourself and employees. After 15% business income tax, you will have $100,000 left in the business. By leaving that money in the business, you can control your tax bracket. The tax implication arises when you wish to take the money out of the business to use personally. There are a few methods of taking money out of the business. Firstly, as a salary, which raises your personal tax bracket. Secondly, as a dividend, which will be taxed at around 39%. This can be a significant tax savings if your personal tax bracket is much higher. And lastly, tax-free from the CDA account. Did I catch your attention with that? Yes, tax-free. The CDA account, also known as the capital dividends account, is similar to your TFSA, which is a tax-free savings account, in that anything you put in comes out tax-free. The primary difference is that there is no yearly maximum on how much you can put in, but that you're limited in what cash flows are allowed to build your CDA account. The CDA is a nominal account in your business, meaning it's an imaginary account. You cannot go to the bank and ask to transfer that $100,000 from your business account to your CDA account. This is an account that your accountant or bookkeeper should be keeping track of on your behalf. So the question then becomes, how can you put money into your CDA account? So there are several ways, but we will speak about two of them. Firstly, through capital gains. 50% of your capital gains flow into your CDA account and will come out tax-free. You receive capital gains through the growth of investments such as mutual funds, ETFs, and stocks. If you invested $100 and that grew to $1,000, then the difference of $900, that is your capital gain. 50% of that, which is $450, will be taxed as a capital gain, while the other 50%, or $450, will flow into your CDA account, and you will be able to withdraw it tax-free. The second way, which is more efficient, is to invest a portion of that $100,000 into a participating life insurance policy. Although it is a life insurance policy, this special policy is primarily used for retirement purposes and is often referred to as a corporate insured retirement policy. Let me show you why. This policy, unlike regular life insurance, is composed of two cash flows. Firstly, the death benefit, which is the amount of money your loved ones will receive on your death. Secondly is a cash surrender value, which is the amount of money which builds tax-free within the policy. The cash surrender value, or CSV, has two components, the guaranteed portion and the dividend payout. The guaranteed portion is a yearly guaranteed cash payment which the insurance company pays into the cash surrender value account. The dividend portion is a payment which the insurance company pays into, once again, the same account, the CSV account, based on their profits for that year, which is highly correlated to interest payments. So the higher the interest rates are in that market, the higher your dividend payments. You'll want to look for companies that are consistent in their dividend payouts year over year. Generally, you should be able to find companies that are currently paying about 6 to 6.5% based on today's interest. And as interest rates rise in the future, you can expect your CSV account to grow even faster. There are two benefits over capital gains. Firstly, the policy acts as a tax shelter, so your CSV is able to grow year over year without being taxed. Secondly, your CSV grows at a consistent rate year over year with very little volatility or fluctuation. Accessing the funds from the policy can be done in retirement in two tax-efficient methods. Firstly, collapsing the policy, meaning you're canceling the policy and taking the entire cash value. There will be some tax implications depending on how long you have held the policy for. Secondly, and more tax efficiently, is collateralizing the policy and taking a loan against it with the bank. Banks will generally allow you to borrow up to 90% value of your cash surrender value account at a preferred interest rate, as it is a secured loan, quite similar to taking a line of credit against your house. You can either pay the interest each year, which is recommended, or allow the interest to add up, in which case the life insurance will pay off the interest and the loan upon your death. Be sure to speak to your advisor or myself to ensure delaying interest payments until death is the most efficient method, as this involves some calculation. If business is great and you don't need to access the funds in the policy, then upon death, approximately the entire portion of the CSV is added to the original death benefit, and it flows out to your CDA account, which passes on to your shareholders, once again, virtually tax-free. So be sure to add your loved ones as your non-voting shareholders to ensure your hard-earned money passes on to them. At this point in time, you may be thinking that this is way more complicated than it's worth. But this simple restructuring of your assets is the difference between $2.5 million and $9 million as your net worth after taxes on death. That's a big difference. Let's walk through an example. In scenario A, you have $100,000 every year in your business to invest in funds, as in your example from the beginning of the episode. Over a 20-year period, that's $2 million in your business. But through wise investing, you've grown it to $4 million. After 20 years of working in the business, you retire and you live off the proceeds of investing that $4 million. At a 3% return, you'll have a yearly salary of $120,000. Not too shabby. Upon death, for your loved ones who must be shareholders of your company, to access the money, they will need to withdraw it as a dividend at a 39% tax rate, meaning that $4 million is now only $2.5 million. That's scenario 1. In scenario B, you have the same $100,000 every year in the business to invest. However, instead of investing the full $100,000 in funds, you invest $50,000 in funds and $50,000 into a corporately insured retirement policy. Over the same 20 years, that $50,000 a year becomes $1 million, and since you invested it wisely, it grows to $2 million. The $50,000 a year into the corporately insured retirement policy over a 20-year period also grew to about $2 million in your cash surrender value account. Getting the same 3% return on the $2 million from funds and the $2 million from the policy, your retirement income is the same at $120,000 yearly. The difference comes in at death. On death, the $2 million from the funds is taxed at 39% and is now only $1.2 million. The corporately insured retirement policy has a total death benefit of $8 million, which is $2 million from the cash surrender value and $6 million from the original death benefit. Virtually most of the $8 million will pass as a death benefit tax-free through your CDA account and will be tax-free to your loved ones, meaning your loved ones now receive a total of just over $9 million after taxes rather than $2.5 million, simply through a more efficient structuring of your business investments. This is just one of the few strategies we can employ with corporations. More for you business owners in our future episodes. I look forward to all your email questions. Have a topic or question you'd like answered on the show? Contact me anytime at mitch@smartmoney.ca. That's mitch@smrtmoney.ca. Tune in for more Smart Money after the break.